In the last 24 hours, spot silver surged from $103 to a peak of over $117. By market close, it had retreated to $107. This volatility occurred without a major macro headline. It was a failure of liquidity and positioning, not a change in fundamentals. But here's what most analysts guessing the top are missing, and I will show you near the end of the video that explains why this FOMO may not be over yet. It's a structural warning that appeared twice before in modern silver history. Both times, what followed wasn't pretty. While retail sentiments remain high, regulators are quietly tightening the screws on the trade. The Shanghai Futures Exchange, or SHFE, has issued a series of increasingly restrictive notices. These are designed to curb speculative excess and maintain what they call orderly markets. To a global audience, these technical adjustments might seem distant. In reality, they are the first signs of a structural ceiling. Since late December 2025, the SHFE has systematically dismantled the leverage available to traders. On December 24th, it kept intraday opening positions at 10,000 lots for certain participants. By January 9th, that limit was slashed to 7,000 lots. As silver continued its climb, the restrictions became even more aggressive. By January 20th, the limit fell to 3,000 lots. Today, the SHFE has restricted the same participants to just 800 lots. This represents a 92% reduction in trading capacity in just 1 month. Margins are also moving. The SHFE increased general margin requirements to 18% and set daily price fluctuation limits to 16%. Simultaneously, transaction fees for closing positions on the same day were raised 5 times to 0.025%. These are not random cheats. They are deliberate frictions. When an exchange raises the cost of doing business and limits position sizes, it forces highly leveraged players to reduce their exposure. So let's pause here. We've just established that Shanghai regulators have cut trading capacity by 92% in 30 days, and margin requirements are now at 18%. That's the regulatory backdrop. But why does this matter for your portfolio specifically? In the next section, I'm going to show you what happens when these invisible frictions trigger forced selling, and why today's price action is a preview of what's coming. The micro-infrastructure shift in Shanghai directly impacts Western financial products like the SLV. Global silver pricing is interconnected. When liquidity is drained from the largest physical trade hub in the East, the selling pressure spills to the West. Highly leveraged speculators are being forced to de-risk. New buyers entering today are stepping into a market where the largest players are being shown the exit by the regulators. We have now seen both the CME and the SHFE tighten conditions within weeks of each other. Historically, this coordination marks the end of a boom, not the beginning of the next leg up. The volatility we saw today is a red flag. For a leveraged trader, this is not just a price move, it's a liquidation event. These intraday swings can wipe out months of safe gains in hours. The invisible risk in silver right now is not just where the price goes, but whether you are allowed to stay in the trade. Recall the margin trap we discussed previously. In December 2025, the CME raised margin requirements from $12,000 to $25,000 per contract. That single move triggered a 15% drop in open interest. Thousands of retail accounts were flushed out simply because they couldn't meet the cash call. Now the SHFE is layering on additional constraints. By bringing margin requirements into the mid-teens and capping intraday moves, they are targeting speculative hot money. Buying into this environment means stepping into a moving floor. In the silver spikes of 1980 and 2011, rule changes were the primary catalyst for the crash. In those cycles, margin hikes were followed by 40 to 70% drawdowns. The reason is simple: forced selling. When regulators change the rules, the long side of the trade becomes a crowded exit. Late buyers provide the liquidity for professionals who are exiting their positions. Now, I want you to ask yourself a hard question. If silver dropped 40% tomorrow, not over months, but in a single liquidation cascade, would you survive that psychologically? Would your account survive it financially? Because what I'm about to tell you is uncomfortable. The people buying silver today at $117 are statistically likely to provide exit liquidity for professionals who accumulated at 60. That's not pessimism. That's market structure. Let me explain why. The current market structure is extremely fragile. We have reached a point where the fundamental story, no matter how bullish, is being overwhelmed by the mechanics of the exchange. If you're using leverage at these levels, you are gambling that the regulators will not tighten further. History suggests they will. When the floor moves, the drop is usually vertical. You're not just fighting the price trend, you're fighting the house. Today's reversal tells us exactly where we are in the Wyckoff cycle. A single day that combines a fresh high, a sharp rejection, and new regulatory constraints is classic late-stage distribution. This is not the calm accumulation we saw in 2025. This is buyer exhaustion. I'll show you the charts in just a minute, but let me cover this important point first. To navigate this, you must re-anchor your process. The question should never be, is this my last chance to buy? The question is this my best risk-adjusted entry? At $107, the answer is no. Professional risk framework requires discipline. In our prior analysis, we emphasize keeping total precious metals exposure to a modest slice of your portfolio, typically well under 10%. But if you adjust based on the currency crisis, that may be slightly higher. Now, we also advocate for small positions and avoiding heavy leverage. They are not just suggestions, they are survival trades. The emotional payoff of catching the top is a trap. The goal of an educated investor is to avoid a catastrophic drawdown. Silver is currently trading far above its long-term fair value estimates. The asymmetry for new buyers is skewed. There are far more ways to lose capital quickly at these levels than there are to gain it safely. The panic tax is being paid by those who fear being left behind. If you miss the move from $50 to $90, do not try to make it up by chasing the move to 118. Capital preservation is what allows you to participate in the next cycle. Professional practice means building position during accumulation and trimming during distribution. We are firmly in the distribution phase. The professional move is to wait for the market to find a new equilibrium. Stay disciplined. Do not let euphoria dictate your strategy. Now, let's get to the charts and see why the FOMO may not be over yet, but getting close. So, here, we are looking at the chart view of the SLV, one of the iShares Silver Trust. What I'm going to show you here is that why the FOMO probably isn't over yet. So, in 2011, we can clearly see this crazy leg upwards, right? Very similar to what we're going through right now. What happened after a couple of months, almost 8 to 9 months time? That comes a big red candle. And what's more important is not just that red candle, because red candles can happen in midway as well, and people can always argue it's going to come back up. What's more important is this large volume bar. All right, 2 consecutive red candles. If you stack those 2 red volume bars, they are actually gigantic. Okay, you can see this oversized the previous white candle by almost like 25 to 30%, these volume. And fast forward to 2021. After a series of price climb, similar sense, the immediately follow red candle did not kill the rally immediately. doesn't look like the 2011 where it started to come down. It stayed flat for quite a while. Not until another month or two later, there comes in another round of red candles combined with even higher volume. If you stack these red bars, they are absolutely more than what was during the leg up. Now we have this consecutive massive move. Just to be careful when it was the leg up, it doesn't mean it's completely safe. Look at these wicks from the top. It means there were people selling. Alright, there are people taking profit already. That's why I said, are you providing the exit or are you chasing the top, right? You think you are chasing the top, but you're providing exit for whoever that sold at these levels. Okay? Another chart I want to show you is the silver with the long-term history. So there were 4 times. Alright, here, starting from the early 2000s, there was a leg up back in August 2003, and it went all the way to the end of first quarter 2024. And here, you can see it took about 9 bars over years, 9 months. This is a monthly chart. And during 2005, similarly and interestingly, remember, the silver price climbed from 2025 to 2026 right now. Back in 2005, 20 years ago, if you believe in 10-year cycle, it climbed around the end of 2005, the fourth quarter, from the candle that lifted the price above the horizontal accumulation zone. From that point to where it started to drop, it took 7 months. So we have 9 months over here, we have 7 months over here. Okay? And then, it's a bit ugly, sorry about that. Let's draw that again. So, the next one is 2010 to 2011. That again, from late 2010 and into May 2011, where it first dropped. That was 8 months. And another 10 years. All right, 10 years ago, 2015, at the end of it, when it moves into January 2016, it started to climb from the low. That took from the very beginning of 2016 to where it started to drop in August. Again, 7 months. So where we are now, how far we have got into this climb. All right, the climb, counting from the very first candle that rose above this horizontal accumulation area. From that point to where we are now, we are already 7 months in. The previous 4 times, the max was 9 months, back in 2003, 2004. If it is going to take another 2 months, that means by the time we get into March, there is a possibility that we're going to see the very first red candle. It may not immediately end. Like I said, if you remember when I talked about the SLV. Back in 2021, that did not finish with the very first monthly candle. It took another few months, almost half a year. It climbed back, okay, from the very first candle to the next that set an even higher high than the initial FOMO. That took 5 months before it actually finishes and actually come down. So I'm not saying silver FOMO is over. It's probably going to last for another few months if it really rhymes with whatever happened back in the early 2000s. All right, or even 2021 when the price of silver tried to stay at a relatively higher level back then. Back to where we were. The question is your strategy driven by data or the fear of being left behind? At Asset Tech, we follow the data, not the crowd. I wish you good luck with your trade, maximize your gain, but more importantly, preserve your capital and ride the next wave. Have a good day.